What's up, everybody? Thanks for joining me today. We are going to talk about how to make money in a sideways market. Today is going to be so awesome. We're going to have some great content for you. I'm going to use a platform called Thinkorswim to share. It's the Bentleys of trading platforms. That's me on Facebook, making sure my stream is working. So thank you for everyone joining me today. Okay. Make sure you guys give me a shout out. Ask me any questions that you have about the material today. Today, we're going to talk about how to make money when the market is sideways. So I'm so stoked for everyone who's joined. Okay. So the market is open. I'm Eastern Standard Time. The market hours are 9:30 Eastern Time to 4 p.m. Eastern Time, Monday through Friday, except on holidays when it might be closed or have abbreviated trading hours. So today's just a regular trading day. And we're going to talk about what happens in the sideways markets. I made some slides for you guys, and let's go. Okay, I'm going to wait for a couple more people to join us. I know we're live, but I know people registered, so I'm going to just wait a little bit and talk about, what you're going to take away from today. So today is all about credit spreads, okay? So the three S's that I really want you to get from this. Hey, whoever joined us. Hey, Jazz, thanks for joining. So the three S's that I want you guys to get from this on the bull put side is support, sell 30 delta, and the set limit order to 80%. For the bear call side, I want you to get three S's as well. Sell at resistance, sell 30 delta, and set limit order to 80%. Okay? So welcome to our masterclass, how to make money in a sideways market. How do we do this? We buy or we sell credit spreads, most specifically the bear call spread on the top side and the bull put spread on the bottom side, okay? I'm going to show you how to construct that on an actual chart, how to manage it, and how to exit it, preferably with a profit. Let's get paid. All right, I'll wait one more minute and then we'll get started. And I'm in a really good mood today, you guys. I don't know if you saw my post on Instagram. I was dancing for you guys because I did an awesome trade today. I'm going to show you that real quick before we get started. So yesterday when the market was about to close, I had a strong feeling that Lulu was going to move either to the upside or the downside. I was biased to the downside just because Lulu has moved so much. And I'm not sure if people are still willing to pay for these, $140 for pants still. And they've made so many other different clothes that people love as well. So I was biased towards the put side. So I put something called a straddle on Lulu yesterday, and this is what happened. So when the market opened, it dropped low of 387, which is like an $80 move. So I was happy today. Welcome to our masterclass, how to make money in the sideways market. And why am I teaching you this right now? You're like, Uchenna, the market's been making all-time highs, like literally 20 all-time highs since January 1st. Well, the reason why this is important is because eventually it's going to stagnate. And it's important for you to know this information when it does, so you can capitalize on the opportunities that present itself. Okay. Yeah, you can make money on buying calls and buying puts, but having more knowledge and strategies in your arsenal will be beneficial as well. So, welcome. Masterclass, how to make money in a sideways market. I'm going to put the disclaimer up for you guys. What this saying is, do not trade with money that you cannot afford to lose. And this information that I'm presenting with you is not financial advice. I'm not telling you what to do. Your past performance, your trading systems, it's solely up to you. I'm here providing information that will help you become a better trader. I'm not making any promises. Feel free to read the disclaimer. That's what it's saying. Okay. All right. So I want to explain to you why I trade. Okay. I trade for freedom. I trade so I can spend time with the people that I want to spend time when I want to spend time doing it. And that is my goal. I trade for knowledge. It's important for me to have mastery of things, and it allows me to feel alive and it challenges me. So, and trading is definitely a challenge. And this is why I trade. I trade to serve. Many of you guys know that I'm also a pharmacist. And I mean, like I was born, I lived the majority of my life with having a service mindset. And that's why I also train other people how to trade as well. So these three things allows me to just stay grounded and focused and, really disciplined on wanting to make money every day from the market because it's not easy. So know what you want, hold it close because that's what's going to keep you going day after day through the gains and the losses. Okay. So what is your why? Why do you want to trade? Write it down, read it to yourself every single day. Okay, so this masterclass is not for beginner traders. If you are a beginner trader and you don't know the definitions of what is a call, what is a put, what is a stock option, then you need to take my course that I have on my website, Dr. KJ Trades. And if you want me to hold your hand through the process, sign up for private coaching. Jazz, can you drop both those links in the chat so people who are interested in going further with me can grab those links as well? So that's for the stock options course that I have, which is a beginner course. I teach you what is an option, what is a call, what is a put, in case you do not know what that terminology is. So this masterclass is expecting that you already know what a long call is, what a short call is, what a short put is, what a long put is. I expect you to already know that terminology. I expect you to know what Greeks are because we're going to talk about deltas and the best strikes to sell on an options chart. I use the platform Thinkorswim. Um, I'm not sure what platform everybody uses, but to me, that is the Bentley of trading platforms. It has everything that you're ever going to need to trade stock options on that platform. So once again, this is not a beginner course. This is for people who have already, are aware with the different options terminologies because we're going to be talking about credit spreads. So these are more advanced strategies that you can use and gain money based upon being in the trade, and you gain something called time premium. So all of this I go into in depth in my course. So if you're not familiar with this terminology, make sure you sign up for my stock options course. Okay. So what this trend fan is showing us that when you want to be extremely bullish, you buy a call. When you want to be mildly bullish, you put on something called a bullish vertical spread, which is either a bull call or a bull put spread. For the purpose of this webinar, we are going to talk about bull put spreads. Okay. Also, we're going to talk about something called an Iron Condor, which is a combined bull put spread, and a bear call spread, which is the mildly bearish vertical spread. And if you're extremely bearish in the market, you can just buy a put. So the purpose of this webinar is to trade neutral strategies flat when the market is going flat or sideways. Okay. And I'm going to show you what that looks like. Definitely not Lulu. You would have got busted out of your bull put spread for sure. So this right here is a chart of the IWM. So the IWM for the past month has been staying within a channel of about 196 to a high of about $10, and that a high of 210, which is that's like a $15 move. It only got to that 210 on one day, and then it sold back off to where it closed at 208. So this is an example of an ETF or stock, and I'm going to be using that interchangeably, of what you would want to put this type of strategy of an iron condor on. Okay. So most successful option traders are spread traders. Okay. Spread. What is a spread? A spread is a strategy that involves taking opposing positions in the stock. Okay. What is opposing positions? Meaning one option is purchased and one is sold. Okay. One position gains value while the other position loses value. Successful options traders capture the probabilities, and spreads create higher probabilities of success because we really don't need the stock to move. What we do is need it to kind of stay where it's at. So just move sideways. It can move up, it can move down, but we want it to stay within a channel. Okay. So why sell options? 75% of options expire out of the money. I believe that number is a little lower because they were taking into account the options that um, might be exercised, but it's good to know this common practice. Most option buyers lose money on trades. So while the option seller earns the profit from the premium, okay? And most beginner options traders start by buying options. So selling options is really, really profitable. It just may be foreign to some people because there's like you're selling something that you don't really have. So I'm gonna try and alleviate some of that uncertainty with the jargon today, okay? So how do you minimize option selling risk? You want to cover your position by purchasing the offsetting option, taking both sides of the trade. Or you can purchase the appropriate number of the underlying stock. That's like doing a covered call. You want to select stocks that have low price volatility. What does that mean? You want to select stocks or ETFs that are not like going up and down like crazy because you want them to stay within a channel. How do you do this? What's the best way to minimize selling risk? Trade credit spreads. I want to show you this trend fan again because it's really important that you know what's going on when I start using this jargon, okay? So what you're going to learn consistent monthly or weekly income generator in a sideways market. We're going to trade two credit spreads at the same time instead of one. And it requires lower maintenance because you're just going to collect money based upon time in the trade. Okay. And it has a higher probability of accuracy as opposed to you buying like a long call or a long put where you really need the stock to move in order to make money. Okay. So the first part or one of the parts of an iron condor is the bull put spread. Okay. This is a bullish credit spread. You usually stay in this trade 1 week to 1 month. Okay. So what is a bull put spread? The construction is you're buying the lower strike put out of the money and you're selling the higher strike put out of the money. Okay. You receive money for placing the trade. This trade as a credit. Give me one sec. Somebody asked me a question. What do you do? Do you take ATR into account? Give me one sec. Do you take ATR into account? Okay, so I'm going to get into that after we're done so you can know how I take ATR into account. Okay. Okay. So yeah, I'll take ATR. I do take ATR into account, but I usually do something called support and resistance, and we're going to get to that. Okay, good question. So bull put construction. You buy the lower strike put out of the money and you sell the higher strike put out of the money. Okay. You receive money for placing the trade, which is a credit. You want the premium to decrease in value so you can buy it back at a cheaper price. You make money based upon time. Okay. These are higher probability, lower risk trades because you don't need the stock to really do anything. Okay. The driver is a short put, the long put is for protection. Okay. That's the construction of a bull put spread. So these are mildly bullish to neutral strategies. First of all, you got to build the strategy. So you sell the strike, you expect the stock to be above at expiration. Okay. It's very critical that you follow these steps so you can have a profitable trade. That's what we all trying to do. We're trying to make money. Okay. So you buy the lower strike depending on the spread risk, and that'll determine how much money you can make or potentially lose on this trade. Okay, so you buy low and you sell high. You buy one strike, one put out of the money, and you sell a higher strike put out of the money. Okay. So what are the exit rules? Favorable exit, 80% of your premium. Unfavorable exit. So actually this is two components to this. Unfavorable exit, either 50% loss on your spread or a change in the trend. So if one of your short strikes, if one of this, like if your stock that you're trading, putting these bull put spreads on, if it happens to have like a black swan event and it's like a whole bunch of selling off, and it breaches your short strike and you don't have a lot of time left in the trade, you want to exit out of that trade. Okay. You don't want to take a max loss on these spreads on either side because it can be a lot of money that you lose on these trades. That's why you want to make sure that you set them up on the right in the right price level on the chart. Okay. And I'm going to show you what that looks like. So what is the bull put spread? This is what the construction looks like. Okay. This is how you would set it up on your chart. Okay. So let's say you have a stock that's trading at $50. Out of the money puts are puts that the strike is less than what the stock is trading at, right? So you would want to, an example of a bull put spread would be buying a $40 put out of the money where you would pay a debit of $2 and selling a $45 put out of the money where you would receive a credit of $4. So the total net credit of this trade, if you put it on just like this, will be $2. And you have to make sure that the proper construction of your bull put is accurate. Okay. You need to make sure that you're receiving a credit from putting on the trade. Okay. So what is your spread? Your spread is just the difference of the strikes. So what are your strikes? 45 and 40. What is the difference of 45 and 40? 45 minus 40 is $5. Okay. So I'm going to annotate that so you see what that means. Okay. So your spread is $5 on this trade. Okay. So your spread is $5 and your credit is $2. So the max that you can make on this trade on the bull put is $2. Okay. $2 or $200 because we know options control 100 shares. Okay. Okay. So the spread is $5 because that's the difference of the strikes. The strikes, one strike is 45, one strike is 40, 45 minus 40 is $5. Okay. The total credit that you receive is $2. So the maximum gain that you can make on this particular bull put spread is $2. Okay. The maximum loss is the spread minus your credit, which is $3. Okay. So I'm going to annotate that. The maximum loss is spread minus credit equals max loss. Okay. This is just calculations that you just have to memorize. Okay. So the maximum that we can gain on this is $2. Maximum that we can lose is $3. Okay. Make sure you guys understand that. Next slide. So the top side of this Iron Condor is a bearish credit spread. That is the bear call spread. Time to trade, same 1 week to 1 month. Okay, how do you construct this bear call spread? Okay, I want to buy a higher strike call out of the money and sell a lower strike call out of the money. Okay. You receive money when placing the trade. That's a credit. And you want the option premium to decrease so you can buy it back at a cheaper price. You make money based upon time. Higher probability, lower risk trade. The driver is a short call. The long call is for protection. Okay, do you guys see that the rules for the bull put spread is the same for the bear call spread? It's just opposite. Well, excuse me, for the placement. The bull put, you put underneath where the stock is trading at. The bear call, you put above where the stock is trading at. Okay. So the entry rules, you want to sell the strike. You expect the stock to be below by expiration. That's why it's out of the money. Okay. You got to buy the higher strike depending on the spread risk. So buy high, sell low. Okay. Exit rules, favorable exit, 80% of your premium, unfavorable exit, 50% loss, or a change in the trend. Okay. So this is the setup of the bear call spread. Okay. Same concept, guys. What is your strike? What is your so if a stock is trading at $50, you want to buy a 60 strike call and sell a 55 strike call. They're both out of the money. How do we know that? Out of the money calls are strikes that are higher than where the current stock is trading at, right? So a 60 strike and a 55 strike call, they're both greater than the $50 stock. That's how we know they're out of the money. We want them to stay out of the money the entire time we're in the trade and end out of the money by expiration or whenever we receive our 80% of our premium. Okay. When we buy this 60 call out of the money, it's going to cost us $2. When we sell the 55 strike call out of the money, we're going to get a premium for $4. The total credit is $2. What is the maximum that we can make on the bear call side? Is $2. What is our maximum loss? The spread minus the credit. Okay, I'm going to retype that. So what is the max loss? Spread minus max gain equals max loss. Okay. In this particular case, it's going to be $5 minus $2 equals $3, our maximum loss. Okay. Maximum gain is $2 or $200, right? Because we know options control 100 shares. Don't forget the basics, guys. And if you're interested in learning the basics, if you don't know the basics, get in the chat, take my course. Okay. I really teach it at a 4th grade level. You're going to love it. So that's the bear call size. So here are the calculations. Max loss equals the spread minus the credit received. Max gain is the credit received. I'm also going to add on here the spread. Well, I did all these in caps. Spread equals difference in the strikes. Okay, make sure you guys understand that. All right, so here's the spread summary. Buying a lower strike and selling the higher strike is always bullish, okay? Buying a higher strike price and selling the lower strike price is always bearish, okay? As the strike prices are farther away from another, meaning the greater the spread becomes more bullish or bearish. So if our spread, let's say, is $10 as opposed to $5, the $10 spread is going to be, more aggressive, okay? The smaller the spread or the narrower the spread is going to be more conservative, okay? The wider the spread, the more risk in the trade because it's going to cost more money, okay? A $10 spread, is going to cost us more, or we could lose more than as opposed to a $5 spread, okay? Make sure that makes sense. Depending on what kind of premium we get, but in general, for that is the general rule, okay? So I'm giving you a credit spread trading plan. So I made this. Take a picture, write it down, whatever, seal it. You can use this for your credit spread trading plan. It's really good, okay? So what is it? if you have a credit spread, you want to sell 30 deltas out of the money. You can go lower. The lower you go, less than 30, the less premium that you receive. Okay. But you want these are not just like huge money generators. Okay. This is like you're collecting premium every day based upon time. They're more conservative, they have a higher probability of being successful. And so the cost is you're not going to get paid as much, but that's okay because we're still making money in the trade. Okay. So you want to sell anything like 30 delta or lower. Okay. You want to sell 30 days to expiration, so either 1 week to 1 month expiration, and you want to receive 20 to 25% return on the risk for your trade. Okay. You need not try, you need to definitely sell strikes either above resistance for the bear call or below support for the bull put spread. Okay. As far as management, we need both sides to stay out of the money. Okay. So we need the bear put, or excuse me, the bear call and the bull put to stay out of the money. That's how we make money on this trade. Okay. If the short strikes, especially any of the strikes, the short strike is the one that's going to potentially be in the money first. But if it becomes in the money, especially if you don't have a long time before expiration, you definitely want to exit the trade because you don't want to lose on these trades because of the reward to risk profile. Okay. You can potentially lose more than you make. Okay. So you definitely want like a trending, flat, sideways moving stock so you don't have to worry about amplitude and volatility and losing on one of the sides of your trade. Okay. You want to definitely exit the week of expiration if especially if the stock is close to the strikes. And the goal is to capture 80% of the intended profit. Okay. So the Iron Condor construction. It's a bear call and a bull put. Okay. They both have the same expiration date, and you can hold it for up to 1 month. You can hold it for longer, but the probabilities I've seen it doesn't increase the probabilities of your trade being successful the longer you hold it. Okay. So it's very common to put it on the ETFs, the IWM, the QQQ, the SPY, the DIAs, okay, and whatever other ETF you might be following, because stocks tend to move more than these ETFs because they're like a basket of so many other stocks. Today we're going to actually place an Iron Condor on one of these ETFs. We're going to take a look at the market and see what's going on next. Okay. All right. So for the Iron Condor, what is the entry? So you want to put these on when you believe stocks will start to move sideways. Ideally, when implied volatility is like high and falling, because as we know, when implied volatility is higher, then you can collect a bigger premium from these type of selling strategies. Okay. The strikes you sell should have less than a 30 delta. The higher the delta, the more aggressive, the tighter on price you're going to get. Okay, that's the trade-off. You're going to get a bigger premium, but you're also going to get tighter on price. So then the wider the spread, the more aggressive. So management, you collect money from time decay. Okay. If any of your short strikes, like we just talked about, any of the strikes that you sold, if they're breached, like if they become in the money and you're close to expiration, you're losing money on one of the sides of the strategy. So I would definitely, manage that and just exit the trade. Okay. You want to risk no more than 1 to 2% of your portfolio in the one trade. Okay. So what are exits? So favorable exit, you set limit order, and this is like a pro tip. This has allowed me to keep way more profit doing this as opposed to just letting these trades go to expiration, because you can just like even before the expiration comes, you can collect 80% on the whole entire trade and then put on another trade. Okay. You do have to pay for the commission fees, by, buying these spreads back. But by far, one of the best practices that I've adopted in my trade as far as my trading. Okay. So favorable, set limit order of each spread to exit 80% gain. And how do you do that? It's just the premium that you receive. You multiply that by 0.2. So that figure is what you would put in your limit order to get you back, okay? To get you out of the trade. So let's say that you receive $2 on, your credit. You just multiply that times 0.2, set your limit order to get you out at 0.4. Okay, so you receive $2, you're setting your limit order to get you out at 40 cents. Okay, so you're keeping that $1.60, okay, which is 80% of the trade. All right. So unfavorable exit when the trend changes. They're like a black swan event. Events that massively move the market. This is unfavorable for these type of strategies. We want neutral, slow grinding sideways stocks. Okay. So this graphic is an image of what an iron condor credit spread looks like. Okay. So you have like this, stock moving up like this, so you had like this moving up, and all of a sudden it found a nice side channel. And this is how you make your money on these strategies. Okay. Okay, so this is the profit range. Okay, so on the top side is your bear call. So you put on a bear call on the top side, bull put on the bottom side, you receive a credit, and you need the stock to stay within the range lower than your short strikes for you to collect premium. That is the purpose of this trade. It's not for the stocks to move, crazy like. No, we want a slow grinder sideways so we can collect something called theta decay every day. Theta decay every day. Theta decay every day. Okay. All right, cool. All right. So how much can I lose on this trade? You only can lose on one side. So for the iron condor on this image, you only can lose. So if the stock goes up like here, then you lose on this side, but you win on this side. Okay. So what does winning mean? Winning means you get to keep this dollar premium, but you lose the max loss on the top side. What is the max loss on the top side? The spread minus the credit. So the spread is $5. The credit was 50 cents. So the max loss on the top side is $4.50. You get to keep your dollar premium. So the max loss is $3.50. Okay. Okay. So that's the max loss. So that's what would happen if the stock goes up and you lose on the bear call side. So let's see what will happen if the stock goes down and you lose on the bull put side. So let's say the stock does something like this. It drops. Okay, so you lose on the bull put side, but then you gain on the bear call side. So what does that look like? So what is the max loss on the bottom side? It's the spread minus the credit. What is the spread? 35 minus 30 is $5. So that's the spread is $5. The premium that you received was $1. So the max you lose on the bottom is $4, right? That's your max loss on the bottom. You receive 50 cents from the top, right? So max loss for this entire iron condor is $3.50. Okay. The max gain that you can make on this iron condor is $1.50. Okay. Why? Because the two premiums that you receive. So $3.50 max loss, max gain, $1.50. Okay. It's really important that everybody understands that. So I want to make sure you understand the math. Okay. The max you can lose on this entire iron condor is $3.50 because of the credits that we receive, and then the spreads of each side minus the credit of each side. The max gain is if you add both those credits together, they're $1.50. Okay. So it's important to really understand support and resistance when putting on these iron condors. Okay. Why? because of the three S's. So important. That's how we construct the whole entire trade. On the bull put side, we want to sell the strike below support. On the bear call side, we want to sell the strike above resistance. So let's look at an options chart. So look at this. This is a beautiful one to put on an iron condor. Okay, so what I'm showing in front of me is a stock or the ETF IWM. So over the past, let's see, 20 days, the IWM, it's had a high of 210 and a low of around 196. Why don't we put on, let's see what type of premium we can receive from an Iron Condor on the IWM. So what I like to do is I like to identify my first, my resistance and my support. So the top side would be the resistance, which I see like around, let's say 210. And the bottom side support would be around 199, 200. So this is the range. Remember the range, it has to trade sideways in a range. So this will be the range that it's trading in. Now let's construct this on an option chain, okay? So you go to your trade tab, and let's say we want to put this on for March 28th, okay? Which is just 1 week. So the shorter the time frame, the less premium that you're going to receive, right? If we're going to go out for a whole month, we'll receive more credit. But because the market has been so bullish, if it's having like a little pullback or a little bit of a selling, then maybe you don't want to stay in the trade as long for like a full entire month. Or you can sell a whole month, but then maybe you want to receive less premium. So if you're going to sell a whole month and stay in the trade maybe 30 days, then we're going to want to set a limit order to get us out maybe at like a 50% instead of 80%. Okay, hope that makes sense. So for the purpose of this, let's see what they're paying. Okay, so always, 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 you have to identify the levels of support and the levels of resistance. Okay, so what is that? Resistance is just the level that, the sellers don't want it to go above. That's your ceiling. And then support is just the bottom, the floor that the buyers don't want it to go below. Okay. And if you want to know more, check out my class on Introduction to Stock Options. It's a wonderful class and I break all this down. Okay. I'm biased, but it is a great class. Okay. So I identified 210, 200 level. Let's see what those levels are going to pay to be in the trade for 6 days. Okay. So the left side is the call side, the right side is the put side. So on the put side, we identified the support at 200. So that is, let's see what that delta is right now trading at about a 12. Okay. Let's see what we can get for a week. Let's see if we would want to do like a $3 wide. So buying the 197, selling the 200, that will give us $17 to put on to risk with a spread of 300. Okay. So if you look at that, so 300 minus 17, 283. So the return on the risk is just the premium divided by the spread minus the premium. Let's see, 283, which is 6%. And we're getting such a low premium because we're only giving ourselves 6 days. Okay. So in order to get more premium, we got to get tighter on price. I don't really want to do that. So let's just go further out in time. So let's say we want to be in this for like a full month, okay? Or the next third Friday of expiration in April is going to be April 19th. So the 200 strike, see if we want to do a $3 wide. That pays us $60. So let's see. So 60 divided by 240, that's 25%. That's more my speed, right? Okay, so let's see what it's doing on the bear call side, okay? We identified 210-ish level, which is a 38 delta. I don't want to get that tight because it's a 38 delta. Remember, our rules say 30 delta or less. So let's actually go above resistance. And why is that? Because the market's been really bullish. So it's saying like, that 38 delta is a 38% chance that this option will be in the money by April 19th. We do not want our spreads to be in the money. We want our spreads to stay out of the money. Okay, that's how we make money. We want to make money. So let's go even further out. Okay, so let's go to, we can go to the 212. And if we identify the 212, that's like a price level up here. Okay, I prefer that as opposed to getting too tight on price. Okay, so how much can we get paid for selling the 212 and buying, let's say, the 215? Keep them $3 wide. Okay, we're getting 72 cents. Okay, so 72 cents, $3 spread minus 72 is 228. So 72 divided by 228, that's a 32% credit. That's still, I mean, that's a lot for these Iron Condors. I think that we can even get further away on price, so it increase our probabilities of this being successful. Okay. The goal is around 25% return on risk. Any more credit that we receive, it means that we're getting closer to price. Okay. So let's actually go further out. Let's try maybe selling, let's see, the 216, buying the 219. That gives us 42 cents. We're looking for a 25% return on our risk, okay? So 258, oops, 42 divided by 258. That's a 16%. That's too far away. So what do we like? We like 215, 218. Let's see what that is. 49 divided by 251. That's a 19%. So let's get a little tighter. Let's do, we could do 214 or let's do 213, 216. Okay, so that's 64-cent credit or $64, same thing. 64 divided by 236, 27%. All right, let's do it. So we queued that up. So we have the IWM. We're selling the 213, buying the 216. So let's see what that looks like on the chart. 213 buying the 216. So let's edit this. Go to 213. And I like to make my short strikes red. And that, wow, that's good. That's far away. So this should be a successful trade. And then let's put the one that we're going to buy. We're buying the 216. 216. I like to make that green. Okay, so you can't really see it. Let's change our time frame here. Okay, so this is where the bear call is right now. So that's the bear call right here. Bear call. Okay, I like when I do my text, I like it to be this color. Okay, so that's a bear call. And then let's do the bull put. Let's cue that up. Same expiration. Let's do, we did 3 wide, so we're gonna buy. So you have to hold the control button down, buy the 197, sell the 200. Okay. So what this is we're doing a bull put, the 197, 200, and then the bear call, we're selling the 213, buying the 216, receive a $1.24 credit, and it's a $3 spread on the bear call side and the bull put side. Okay. So let's confirm. This is for one contract. We can buy 5 contracts, or depending on how much are you willing to risk. So if you're 1% of your account, you're trading $100,000 account, then maybe you can risk $1,000 on this trade. Okay, so just make sure you do the math based upon the size of your account. Okay, so oh, this is $1 million account. It's my favorite trading account. All right, so let's do 10 contracts. All right, confirm, send. Okay. So it's going to be in our working order right now. So we're waiting on the market makers to get this filled. I'm just going to ask for less credit because, we're live and I want to make sure it gets filled while we're here. So let's see, cancel, replace. I'm just going to ask for, let's say, $1.20. Okay. Confirm, send. So it's working. The 120 is working. Let's see. So now we're still waiting. There we go. We just got filled. Okay, so pro tip, and that's the third S. So what we did, number one, we placed the bull put under support. We placed the bear call over resistance. We did around the 30 delta. And number three, we want to set the limit order to get us out at 80%. How do we do that? I personally like to set my bull put and my bear call separately, as opposed to doing the whole entire Iron Condor at 80%. I found that they're able to get filled faster that way. So that's the way I'm going to teach you today. Okay, so the whole entire bear call, and we can always check, we can always see, why don't we do order to get us out at the 80% for, let's see, for 5 contracts. And then we can break up the bull put and the bear call to get the other 5 contracts to get us out separately at 80%. Let's do that. That sounds like fun. Okay, so what you do is you right click on the order, create opposite order. And then what was the credit that we received? 120. So let's see, 120, remember, times 0.2. So $24 is what we're going to put to get us out. We're only going to do 5 contracts. And then we're going to do an order to get us out at 24 cents. Okay. And then we're going to change the date to GTC, good to cancel, confirm, and send. So what that is 5 of those contracts of this IWM we have an order to get us out when the entire Iron Condor is at 24 cents or $24. So now let's put an order to get the bull put out at 80% and then the bear call out at 80% at the 5 other contracts that are remaining. Okay, so for the bear call, we received 181 minus 117. So 181 minus 117. So we receive 64 cents for the bear call. You multiply that by 0.2. So we're going to put an order to get us out at $12 for the bear call. So 12 for the bear call. And the bull put, let's see what we got. So we did 175 minus 119 for the bull put. 56 is what we received on that side. So in order to get us out at 80% will be 11. So 11 for the bull put. If you guys have any questions, make sure you ask. Okay, so we have 5 more contracts that we need to put in order to get us out at 80%. So in order to do that, I'm going to go to my activities and positions and go to my actual order of the IWM. And I'm just going to create a closing order. So I'm going to check that, then check this, create. So I had to highlight both of these. You had to hold the control button down to do them separately, okay? So the bull put side, create a closing order. So not the all 10, we're just going to do 5. 5 to get us out. This is the bull put side. So we want $11 for that one. And we got to change it. Good. GTC, confirm, and send. And then now let's do the bear call side. Highlight one, hit control on the other, right click, create closing order. We only want to do 5 because we already have an order in. And then we're going to do $12 to get us out of that one. And then we got to do GTC. And then we confirm and send. So in our monitor tab, we have in order to close out 5 of the bear calls and 5 of the bull puts at 80%. And we have an order to close out 5 contracts of the entire Iron Condor at 24 cents. Okay, this is our masterclass on Iron Condors. We learned how to construct them, what to do. So we will learn how to construct them, support, sell delta, and we learn how to manage them and how to get out of them. Okay. So on our chart, this is the way the trade will look. Oh, you know what? Let me put the bottom side on here. So we did the 197, 200. So let's put that on here. So 200. I always like the red on my short side. And then 197. 197. Okay. And then let's put the text note like we did for the bear call side. So this is the bull put side. I love this. So in order for our trade to be successful, this is what we want to happen. We just wanted to do this, okay, for the next month, okay? And that's it. That's an iron condor. Make sure you guys understand this. I really want you to I really, really want you guys to be successful, okay? It's so important that you construct this iron condor this way. Got it? Okay? So the bull put has to be under support. The bear call has to be above resistance. 30 or less on your delta, and then set your limit order to get you out of 80%. And then you just print money. Okay? All right. All right. All right. Theta decay every day. All right, you guys, that's our time. As far as ATR, I answered that. Average true range, I really don't look at that much because I want to tuck it under support and resistance. Average true range is just like, what is the expected daily move of your stock or your ETF? You can take a look at it and then it'll help you decide on if you want to get further away in price, but make sure you put your spreads under support and resistance. That's king. Okay. That's king or that's queen. All right. Very, very important. If you guys have any questions at all, feel free to leave me, a message on my Facebook or send me an email. And if you're interested in learning about introduction to options, here's the link below. It's in the chat. Sign up for that course. I am increasing the price because I'm going to add more material to it. Right now it's $197. And of course, I have private coaching because the fastest path to mastery is through coaching. So all that is on my website, www.drkjtrade. And thank you for joining me, taking the time out of your Friday to be here with me. Much appreciated. All right, let's get paid. See you later. Bye.